All right, guys. All right, guys, we're about ready to get started here with today's webinar. We are excited for a couple of reasons. We are going to be discussing our property called Aspen in Fort Worth, Texas. And today we've got with us, leading the webinar today, one of the managing partners of MF Capital Partners, Mr. Ryan Wooley. And so we're going to turn it over to him to go over some of the information here. As with the other webinars that we've done, we will be taking some questions on the chat box. There's a little Q&A button. If you have any questions throughout it, I will be helping moderate the call here with Ryan and answering as many of those questions as possible. So go ahead and ask away as Ryan gets into some of the numbers on this deal and a little bit of the information. So we're going to turn it on over to Mr. Ryan Wooley. You ready, Ryan?
Yeah, I am. Awesome. Well, it's good to have you guys on here. So it's an amazing opportunity. I always talk about the new opportunities coming to MF Capital Partners. So as Eric said, those of you who don't know me, I'm a managing partner at MF Capital Partners. My partner is Tyler Devereaux, the other managing partners. A lot of you guys know him. In fact, those of you on here, I'd like it to be very interactive. Go ahead and put in the chat if you know who Tyler is. Or is this your first time watching an MF Capital Partner webinar? Awesome. I see some people either very familiar on here. Caleb, great to have you on here, Caleb. Awesome. First timer here. Good to have you on, Mike. Neil, good to have you on. Good deal. Tyler's awesome. Good deal. He actually, Tyler was actually going to make a guest appearance on the webinar. It's not too often we are able to have him on due to the potential hurricane coming through Florida. He was in office. He actually is doing an event up in Charlotte. So he flew out a day early. So he won't be on today's webinar. So unfortunately. So awesome. Someone said first time, Crescencia, good to have you on here. Cindy, awesome. Good to have you guys on. First time, Mr. HP Laptop. There we go. Good deal. Awesome. Well, let's dive in. A lot of the things that we get in today's market is people saying, hey, is it good opportunities to invest? Right? Is it a good opportunity to invest in multifamily right now? Inflation obviously is coming a little bit down. Interest rates are still at all-time kind of high right now. Really, are there properties out there? A lot of what you're seeing too is people that got into properties in 2020, 2021, they got into what we call bridge debt. Bridge debt was an opportunity to fix up, deals that were not stabilized, right? Obviously, the opportunity we're talking about right now is Aspen. Aspen was a property we acquired, a few years back, and we had a 2-year bridge debt. On that one, in order to get it into a long-term debt, we need to restructure that. And so today we're talking about the restructure, the opportunity for you guys to jump in on this. And I think it's an amazing opportunity. We just had a call with the existing investors on it, letting them know that we were restructuring the debt and putting it into a long-term piece. Now, when I say bridge debt, it was a short-term to be able to stabilize it, 2-year loan. That was going to go into an agency debt. Being at where we're at today, we have to essentially what we call buy down the debt. Okay, 18.6 million was the original debt piece, and on that original debt piece, in the market because rates going up, the new debt piece is $10.3 million. So in today's webinar, we're going to go over some of the opportunities with Aspen, the things we're going to do with Aspen, the numbers of where they should be at, and really what at the end of the day, what the opportunity is for you guys. So I'm actually going to share my screen here, and then Eric, if you could help me out with questions. Like I said, folks, I want this to be very interactive. Okay, this is about you guys asking the right questions on the opportunity we have. So you can see here, Aspen Apartments. This is located in Fort Worth. So I would love to see what is the #1 market in the country. Let's see if you guys know that one. It's the #1 market in the country. Go ahead and put it in the chat if you know. Boca Raton. Love Boca Raton.
Dallas, Michigan, Provo, Texas.
Provo is. Yeah, Brady Barker.
A lot of Dallas.
Brady. Yes, Brady. Provo is. There you go. Large market for sure. DFW, the Dallas-Fort Worth market, has been one of the top markets in the country for about 15 years. All right, just the population growth of what is going into Dallas and the jobs going there, economic impacts in the DFW area has always remained at an all-time high. Yeah. Matt, you wrote Fort Worth number 2 ? Yeah, actually Provo has been the number 1 market the last 3 years, but over a 15-year period, DFW has been the number 1 market in the country. And the reasons why is the different jobs that are coming in here, the growth, the population growth. One of the biggest things, I put Florida in there. I love it, right? I mean, we can talk politically of why. A lot of people, population growth is coming down from the East Coast down into the Florida market, specifically Orlando. But yeah, the DFW area. What happens? You get a lot of the businesses from California have pushed into the Arizona market and into the Texas market, which is allowing that population growth to stay up. And so we'll go over that. First of all, for those of you who don't know us, let's actually hop into who we are. This is what we're going to actually be going over today. Who MFCP is, the investment highlights, what the returns are, and the next steps. All right. So a little bit about us. We went over what who Tyler is, who Ryan is, but a little bit about MFCP, MF Capital Partners. We own over 3,700 units. We have 2 offices. We have a great office in Maui, and then we have an office here in Orlando. We have 22 team members on the investment side. We're invested in 6 different states. We have close to 400 million in our portfolio we've owned and operated. And guess what? This last one is the best thing. It's the number 1 thing that I like to look at. The equity we've created for investors, almost $120 million. You'll see, and I'll go actually over our track record. It's one that I actually don't like to talk about, and those numbers are right here. When you're looking at a property in a market, a lot of your operators out there talking about your preferred returns, right? I always say this is a teaser. When you look at your annual rate of return, it's typically broken down into 2 different pieces, right? You've got what you call your preferred return, right? Or your cash flow, each year. Most of them, it used to be 8% in the market several years back. Why? That's because properties were cash flowing. In today's market, you're seeing more of a 6%. Remember, you always want to underpromise, overdeliver. Make sure we're hitting proper expectations. And so one way to look at it is the cash on cash on a property. All right. What does the cash on cash look like in the property? The reality is what's the projected and what has a company actually done when it's gone full cycle, right? What has it done when it exits? So in our portfolio, we've projected 7.85% cash on cash on a property. At exit, we've been right around 12.65. Okay. What does that mean? A lot of people actually get that confused, right? They think it's the preferred return that goes into their pocket. No, that's actually from acquisition, okay, to exit. What does a property actually do? I'm actually going to show you a live underwriting. I wasn't going to do it. And then Eric was like, no, dude, it's the most awesome thing that you can do is actually show a live underwriting. So I'm going to ask you guys, I can actually talk about the numbers. I can actually show you an underwriting, and most operators won't show you the behind the scenes underwriting, what that actually looks like, what the property should do, and what that looks like. So when we get to that part, yeah, please. Someone said, please. Yes, definitely.
In capital letters, please show.
Please show. So underwriting. Yeah, underwriting is the key to it. In fact, we were talking to the director of operations today. What's amazing about investing in multifamily and real estate in general, right, is all about numbers, right? The numbers don't lie. They tell us what we need to know. And so the actual when we left is 12.65. What's that mean? It means the property has the ability to pay you out a preferred return. Okay. The preferred return is what you guys are looking for. I say a teaser. That's what you get paid each year until you exit. The equity is where we really make our money, right? But that preferred return actually pays it. So the cash on cash will show us that. The annual rate of return on all of our deals, we've projected about 22%, 21.8% in an annual rate of return. Okay. Well, our actual is 38.02%, 0.02, right? 38% we'll call it, right? Here's why I hate this number. Part of the biggest things in MF Capital Partners is transparency, right? Is what does it actually do? We want to underpromise, overdeliver. The reality is where does that 38% come from? We actually sold off a large percentage of our portfolio in South Carolina that averaged over 38%, right? Which actually brought down that number to 38%. Now, we sold it at the height of the market. Everything in real estate is cyclical, right? We all go in cycles. Some of those markets are 5-year cycles, some are 7-year cycles, some are 10-year cycles. During the Trump administration, he extended that cycle out. You usually see a correction really every 7 to 10 years. You're seeing a correction. That one extended out a little bit of time, and we don't need to get into politics of what was good about it, what was bad about it. But guess what? For a long time there, interest rates were extremely low. On this deal, when we first got into it a couple years back, it was at 3.5%. And we got into an adjustable rate loan. That adjustable rate loan went up. And then we had what we call a rate cap. So it capped out what allowed that interest rate to go up. But in this case here on the annual rate of return, we exited at the right time. Everything in real estate is during those cycles. And in those markets, how do those cycles work? We want to actually buy during the right time, and we want to sell during the right time in that cycle. At that 38%, we just sold at the right time, and so it pushed that number up. Now, remember this. I'm going to talk about this opportunity at Aspen where it's right around 16%. Okay, let me ask you this. If you got into an investment in today's market, knowing that you could make 16% return on your money, how many of y'all would invest? I'm going to run and grab a drink really quick, Eric. I did not grab that. Put in the chat. How many of you guys
have that? So they're going to be putting it here in the chat. You've got the absolutelys, the of courses, the yeses. We know what 16% return is. So obviously you have a lot of yeses in here. So
yeah, Brady Barker, I hope you would.
Brian, yes, right?
I'm going to give Brady crap. I tell you. Brady's a good dude. Good dude. Serves in the military. For those of you who serve in the military, thank you so much for your service. Brady's an active military. So yeah, 16%, which is funny, man. I tell you, a couple years back, Eric, right? I mean, a lot of us, in 2020, 2021, you saw a lot of operators saying they could do, 19, 20, 22, 23%. In today's market, I just had an opportunity pass to me. I passively invest as well, just like you guys. Someone passed an opportunity of 23%. Hey, this deal's going to kill it, 23%. Look, it might, right? It might, but I want to set realistic expectations. I said to an investor recently, look, if I tell you 23% and I hit 21%, are you going to invest with me again? Or am I going to invest in your deal again? The reality is this. It's under promise, over deliver. Okay. If someone tells you 23, 24%, they get you 21%. Yeah, that's a great return. Still, it's a good return, but we didn't follow through. We didn't fulfill on what we told you, which, MF Partners, I'll tell you this, I'm a firm believer at this. Okay. I'm going to tell you 16%. I'm going to do everything I can to get you over that number. Okay. As you can see in our track record, we've done that, but we've exited at the right time. So let's go on a little bit. Let me tell you about Aspen Apartments. Man, I hope that you guys are excited. I'm going to hold you guys to that. How many of you guys would invest? It was 16%. Like I told you on this deal, it's a restructured deal. A little bit about Aspen Apartments. It's just outside of, it's in the Fort Worth market, just outside of Dallas, one of the top markets out there in the country, right? Like I said, market rent growth is still super, super strong in this market. This deal is a 224 unit deal. It's a $21 million purchase price. It's a 16% annual rate of return. So Eric, I'm going to hold them to that, right? They said 16%. Someone said depends, right? Yeah, totally depends. All right, Rick, I'm going to sell you on this. 16% return. The total equity we need to raise $10.3 million. The debt on this piece, okay, was originally $18.6 million. Like I said, we got to buy down this debt in order to put it into long term. On this deal, it's a 7-year note. Okay, doesn't mean we're going to hold it for 7 years. This is a 3 to 5 year hold. 3 to 5 year hold on this deal. Okay, sorry I didn't update the slides on it. I should have updated the slide with the hold period. This is a 3 to 5 year hold period. The note is over a 7 year. Okay, we have 2 year interest only on this deal. So the equity that we're raising, I love that the Bodines are on here, right? Nate is the underwriter. Caleb, his brother, is on here as well. So 10.3, what's that take us to? So if the debt that we're going into is at 10.3 million, the equity we need to raise is 10.3 million. What does that take us to? 20.6 million. Yep. 20. You got some fast people in here. 20.6 million. Eric was out there getting his calculator out. I mean, here's the thing, Eric. Look at, part of underwriting, you just have to have that big calculator, right? You have to have a big calculator. You can put those numbers in. So all in this deal is 20.6 million. What does that mean for you all, right? What does that mean for you all? Okay. Here's the thing. We say that we have to restructure this debt, which means what? We're going to have some existing investors who we're taking over into the new deal. Okay. We're taking that new piece in. One of the biggest things at MF Capital Partners, we like to be transparent. We said, one of the things we know that we're going to get you some documents after this call. It's a PPM, right? For those of you who haven't invested before in multifamily or into any securities, that's a private placement memorandum. Okay, that's going to be sent to you an opportunity to invest with us, and it's going to have different waterfalls, right? And within those waterfalls, it's going to tell you who's investing in the deal, what investors are in there, and at what level do they get paid out, right? The last thing we ever want is for you guys to look at that and say, hey, who are these other people? So we're going to take existing investors in over to the other deal. What we're doing is we restructure it. The new money will be put into the top position, right? They'll be put into the top position, and they'll get the first 16% that comes in on the new loan. And what's amazing is this, right? This deal, we were offered an opportunity to sell this deal at $24 million. Okay. As I go over the underwriting, I'm going to show you this deal. We're actually going to exit at $37 million. That's at holding this deal for 5 years. Okay. At 5 years. And now we had a few people actually ask, how do we invest? How do we schedule some time with you? You'll see that that Rosie will actually post in a link that you can schedule anytime. You can click on that link if you're interested in investing as I'm talking about this. So what it is on this deal is if we were to sell at $24 million on the new debt piece that's coming in, hopefully I intrigue you here, right? If we sold the deal at $24 million, you guys said at 20.6, at $24 million, how much would be left over? We sold the deal for $24 million minus 10.6 million. Sorry, it was 20.6, right, Eric?
Yes.
20.6, 24 million. I got excited there, Eric. I got excited. Right? 3.4 million. I mean, Grant is quick. Grant's quick here.
Grant don't need a calculator, man.
Right, leaves it at 3.4 million. I actually want to show you something here. I'm actually going to show you some of the numbers in the live underwriting when we get over to it. All right. Actually, should I just jump over to Eric? You want me to jump over to live underwriting right now?
Yeah, let's do it.
Awesome. Let's jump over to it. Okay. One of the biggest things is this. I can show you some slideshows. I'm not the most technological person. So I'm actually going to show you. Some live underwriting here. Actually, how do we come to the numbers that we're getting to? I'll tell you, so people ask, hey, Ryan, how did you get into this? I actually graduated. Can you see that right there, Eric, the underwriting?
I can see it. It's coming up just fine, Ryan. Yep.
Awesome. Okay. So the thing with this deal is, how did I get into it? I graduated in accounting. Okay. I graduated in accounting. I love numbers. I always thought that numbers told a story, right? Numbers tell us exactly what's going on a specific deal, right? And so I knew that if I could always tell a story, that we could raise money to get into deals, right? Our team, if we had the proper numbers of exactly what's going on, numbers don't lie, right? What goes in the bank, what's being spent, it's income versus expenses, really, right? We've got to be able to project and forecast out. And that's what really makes a deal good, right? But as you can see here, I like to look at the returns. A lot of people ask, here's the thing, Ryan, where are we at in today's market on this deal? Everything is driven by your net operating income. Okay. Now these numbers, don't look at them. They're going to confuse the hell out of you until I explain it, right? They're going to confuse the hell out of you. So a lot of people always ask, how do you sell a multifamily property? How do you determine what you can sell it for? Right? Do you guys know the answer to that? It's based off your net operating income. Okay. It's based off, yep, your NOI. A lot of people put in your NOI, right? So you got your net operating income. It's also based on the cap rate during that time. What we saw, really as interest rates went up, what happened? Cap rates went up, right? As interest rates start to come down, you'll see cap rates come down. Remember, we talked about cycles and how cycles work, right? They're indicative of what happens. I talk politics, but I just don't talk about it at the dinner table, okay? I'm going to talk about it right now, though, okay? We're crazy to think that politics don't play a part in what happens in real estate, right? Typically, when Democrats go in, interest rates go up, okay? I'm going to go full cycle here. I'm actually going to go full cycle. As Democrats get in, interest rates go up. When conservatives get in, Republicans get in, interest rates go down. Well, when interest rates go down, cap rates go down, right? So both are good. I love it when Democrats are in office. Why? Because we want to go and we want to buy properties. We want to go buy properties. It's a great opportunity. When Republicans are in office, we want to sell properties, right? And so in this and getting into a long-term debt, currently in today's market, all right, when we underwrote this a couple weeks ago, the NOI based on last month was at $1,054,597. All right. One of the biggest things that we like to do is work with our investors going, hey, if I could sell the property for $37 million, right, or whatever that exit price is, I want to know as a passive investor, what does that net operating income need to be at to sell it at that specific number, right? Well, the good news is this. In today's market, right, the numbers just went up on this property. Over the last 3 months, okay, what we do is we take the last 3 months and then we annualize it. It's showing us where the property is trending to. All right, like we said, we're restructuring this debt and we're putting it as a long-term debt. So I want to look at trends, and I want to show you new investors what those trends are doing. In today's market, right, based on the last 3 months, our NOI annualized is $1,159,396. So you can see right here, based on the underwriting that you see, right, we're already ahead of schedule. Okay, we're already ahead of schedule of where this is trending, of where we want to be at. Okay, now if in today's market, right here, we could sell this property for $21 million. Okay, which is why you see the purchase price is $21 million. Okay, next year, right? Here's the thing that I like to tell. All of it is typically based on forced appreciation. Forced appreciation. Well, you don't see a lot of operators that demonstrate or show you all based on just organic, right? Organic growth. Okay. How many of you guys have invested before? If you knew that it was just based on organic growth, not forced appreciation, would actually invest into a property? Would that be safer or less safe? Right? We're not forcing the appreciation, meaning it's $100, $100, $200, $300 on increases, right? Typically on a lot of properties, what we did is we'd find properties, Eric, right, that are mismanaged. They're $200 below market rent. Never would we ever have invested in the past for deals that are organic, right? Organic growth, meaning it's right around 3% annual growth. A lot of the deals we're looking at are, 8, 9, 10% market rent growth. Less safe without forced appreciation. Yeah. Gabriel, I'm actually going to show you, Gabriel, this, right? You would think it's less safe. Okay. Right? You can see the returns that are right here. The annual rate of returns, the annual cash on cash is 8.7%. Remember what we talked about. Okay. We want to know that cash on cash has the ability to pay out the preferred returns. That 6% to you go. I always say, like, it's a teaser, right? It's just money that comes into your pocket that you're able to pay bills with or go on vacation. Eric likes to go to Belize, so he spends his returns, on trips with his wife. So a few times, right? Yeah, a few times. Yeah, that's just that passive money going into our pocket. We're able to do things. So in year 2, right? In year 2, we should be at $1.4 million in NOI.
Hey, Ryan, while you're getting a drink there, I just want to make sure everyone realizes too, they're putting in here answers to some of your questions, but making sure that they're asking questions too. So we've got the chat open on our side here as the panel here. So if a question pops up as Ryan's going over all this underwriting, make sure you ask it so we can kind of make sure everyone's clear with the path of where this property's heading.
Yeah. So you can see here is this. Lottie said it's less safe, right? But what if I could get into an investment where it was just based on organic growth? That's the beautiful thing about Aspen, right? Is we're buying down the debt, which means that your principal amount is lower, right? So we were putting more money into it. We're buying it down to get the interest rate lower. Okay. We're getting the interest rate lower, which means the property will cash flow. Okay. Which means we can control our expenses, right? Real estate taxes will be less, right? So what we're trying to do is control our expenses and make the property cash flow better. So we're buying down that principal amount, putting it into long-term debt, right? Long-term debt. Our interest rate's going to go up a little bit more. Absolutely they are, right? They're already projecting by the end of the year, they're going to go up 2 more times. That's not meant to freak you guys out. What it meant is that you have operators that are putting and looking ahead and forecasting. Eric's actually on our acquisition team, right? And he's always looking forecasting. He's not looking today. He's looking at 2 years from now, 3 years from now, 4 years from now, what's going to happen so that your returns stay the same. Okay. So in this deal, as we restructure the debt, we're looking at the net operating income. Now in year 2, okay, we should be able to get that net operating income to 1.4 million. And let me tell you what that does. What do we have to raise that property what do we have to raise that property to get there? $67 a month. $67 a month is all we have to do. In this market, that's organic growth. Okay. That's hang on. One of the questions, what went wrong with the property? Is all went wrong because interest rates rising, nothing else. Yeah, awesome question. I'm gonna actually address that here in just a minute. That's an amazing question, because a lot of people say, what actually went wrong with their property? There was nothing that really went wrong with the property outside of this. It was originally a 2-year bridge loan, which meant we needed to stabilize in 2 years. When we acquired the property and we got into it, COVID hit, right? COVID didn't allow us to be able to raise those rents. We actually had the wrong management company. We had an AI company came in, and we thought the AI at the time, right, during COVID, would be the best way to get rents in, to be able to collect rents. Well, we kept them on for 6 months. And in 6 months, they weren't doing their job, so we had to switch it out. Well, typically it takes a property when you acquire it another 6 months to stabilize, right? And as you stabilize that property, right, that took us a year in. Well, typically when you get into a bridge debt, you got to go right out of the gates to be able to stabilize it, to get it into a place to put it into long-term debt. So to answer your question, I think it's Pankaj, I think is his name. I apologize if I mess that up. But what happened is the whole plan on Aspen was always to stabilize, go into long-term debt, right? Because of interest rates, so exactly to your point, interest rates went up, okay? And we wanted to get rates into a stable rate. Well, the reality is that NOI was not where it needed to be. Once again, remember, COVID hit. We weren't able to evict, so we weren't able to raise the rents the way that we normally would, okay? Now, I don't foresee another thing like COVID happening anytime soon again, right? But the reality is that pushed our business plan back a year, right? So where we only had 2 years to stabilize, we weren't able to do that. The trends over the last 4 or 5 months of what we've been able to do with the property, right? If we had another year, we would be right on track to do exactly what our business plan was. So you can see that number right here, 1.4 million. We would be able to sell that property for 28 million, which would have put us right at that business plan. So when we look at Prakash, if we thought that hopefully that explains your question that you have, is what we were able to do with the property. There was nothing necessarily that went wrong outside of COVID set us back a year. That's exactly why we have to buy down the debt right now, right? Is to put it into long-term debt. Hopefully, great question there. So in year 2, we got to be at 1.4 million. Remember, what did I say? If you took the profits, if we just sold it in year 2, okay, we were able to sell it for 28 million. Eric, I said we were right at what, 20.6 million.
Yep.
Okay. So if you were to take 28 million, let's just do 20, you don't have to do 310,000 minus 20,600,000 was the number, Eric, right?
Yes, sir.
Would be $7.4 million in profits. Okay. Now let's test everyone out here, Eric. Okay. What was the initial investment? It's right down here in red, right? If you can see my cursor. What was the initial investment?
$10.3.
Grant, you're going to get an award here, man. I tell you.
I think you need to answer a question too, Ryan, since he's the one answering here, man. Did you see Grant posted a question up here?
Organic growth.
Organic growth equals raising rents. Is there anything else that can make it organic?
No, we're talking Grant, more forced appreciation is what you're looking at. Organic growth is typically 3% a year in a market. Depending on what market you're in, each of them have different organic growth. In this market, you're right around 3% is organic growth. Yeah, great question on that one. So 10.3, right? You take 7.4 million is the number, right? If you were to take 28 million minus the initial investment of 10.3 million would be 7.4 million. If you were to take 7.4 million divided by the initial investment, okay, that's almost 72% return on your money, right? Now we would sell at the end of the 2 years, right? Or 3 in the 3rd year mark, okay? Really, AMF Capital Partners, we've held properties when they're stabilized. When they're stabilized, right? We've never held a property longer than 3 years when they're stabilized. Why? Because we understand how the market works. We understand what the net operating income is, right? We understand that you have to drive up the net operating income to get the returns that you're looking for, right? So I want you to think about this. If you got 72% return on your money over 3 years, what would that work out to be? A decent return, right? It's a decent return. You can see why we're so excited, okay? At putting new investors in and buying down the debt and putting this into a long-term debt piece. All right. There's not many opportunities you look like in a deal where, guess what? The new money would go into the new debt piece, right? And they would get 16% return. One of the questions I asked you guys at the very beginning, if you had an opportunity to invest in a deal where you could get 16% return, how many of you guys would invest? Right? Quite a few of you saying yes, right? Absolutely, you'd invest. Okay, I want you to look at this, right? You know, I want you to look at one of the best things I ever learned in a finance class is time value of money, right? The longer we hold an asset, right, sometimes the more it appreciates. You know, someone asked a question, why would you just hold a property long term? Well, the thing is, we want our money to work for us, and we want to put it into other opportunities as well. Okay, if we could get you your total return, right, your 5-year returns in 3 years, right, and then take that money and put it in another asset to be able to make sure that equity works for you, right? Is that a smarter business plan, or holding it for long term where you're just making consistent money? Now, it depends on where you're at as an investor, right? Consistent money is great. Consistent money is great. But most people that I talk to, most investors, they want equity because they realize what equity does for them, right? The equity can put into another deal and then make more cash flow, right? Smart investors will take that equity and put it into deals and make more cash flow, right? You know, that's what they do. And so the reality is this, you know, even though if we were to hold this property for 7 years, okay, I want you to think about this. Now, this is the number we could sell it for, $41 million. Okay, the initial principal on this deal, right? The loan on this deal, 10.3 million is what we're buying it down to. So I want you to think about the opportunity, right? Yeah, Monica says much better, absolutely, right? So part of the thing in investing with us at MF Capital Partners, we want to educate you, we want to teach you exactly what your investment can do, right? At getting 16%, we want to show you how to get that 16%. And a lot of what we show you is just that growth in the net operating income, right? And you see how it grows here. You get with a lot of operators, and this would go up even more than this. In your 3rd year, it's at 1.5, almost 1.6 million. Okay. You have 4th year, 1.7. Extremely conservative numbers. Okay. The next year, only $100,000. Okay. Extremely conservative to get where we need to be. Right. One of the biggest reasons that we're doing this, like I said, is we're going to get into a long-term debt and we have to buy down the loan. You guys just get to take advantage of it. Right. You get to take advantage of us restructuring the debt to get into long-term investment, right? A long-term play. Once again, this deal is I'm actually going to show the other screen here, if you will, Eric. Boom.
Yeah, if you guys have noticed, Rocio has been putting up a link on there to go to. If you want to set up and schedule a call with someone on our IR team to look into this investment here. So make sure you follow that link that Rocio's been putting up on here.
Awesome, Eric. So I'll get going here on this one. So you can see this is 6% preferred return, okay, in today's market. Should the property do better than that, right? The preferred return will go to you guys as well, okay? The 6% is what we're looking at. This is a minimum of a $50,000 investment. This is actually for non-accredited right now, okay? The non-accredited will go to September 15th. Okay, I want you to think about this. After September 15th, we're going to accredited investors only. The SEC actually blessed us this year with allowing us to do non-accredited to accredited status on investments. So for those of you that are not quite accredited yet and want to invest in an opportunity, the minimum investment is $50,000. Those funds, right? Those funds are due by the 15th. I want you to think about an opportunity like this. Not too many opportunities where you can make 16% in today's market, where you saw all we got to do is sell that for a little over 24 million to be able to get that 16% return, right? You saw exactly what the property should do to be able to get that 16% in today's market is almost unheard of. I hate the word guaranteed. I'll never use the word guaranteed, right? Real estate's a risk. Real estate is always a risk. You know, the reality is you saw if we hold the property for 7 years, what we should be able to sell the property for, right? Real estate is a risk though, right? It's making sure that you get with operators who are always forecasting, looking out, you know, doing exactly what we're doing and restructuring the debt, putting it into a long-term piece to make sure the investor experience is always there, right? To make sure that the investors are going to get the return that they want as well. And that they're able to trust us as a team, making sure that we're protecting their money. So really quick.
Hey, Brian, can I interrupt for a second with a question I think is important to address here real quick that I've come across the chat there. Monica asked, does it pay in any way for them to wait if they're accredited, or should they jump in by September 15th also?
I love that question, Monica. Great question. You want to jump in during the non-accredited status, right? You want to invest sooner than later. The reason why is if you're accredited, you have to get verified. Right now, during this opportunity, if you're accredited, you should jump in before the September 15th date. Listen, I'm accredited, and what's great about it, if you've done an investment in the if you've done it recently, that accredited status lasts 5 years now. That's something the SEC actually changed this year. That lasts for 5 years. Monica, if you have not gone through that process though, you just have to get verified from your CPA or from your attorney, letting them know that you're accredited. So during that time, if you're accredited, it pays to jump into it right now. It literally pays to jump in right now. Okay. So great question there.
And then there's a couple coming up here, Ryan, too. I just think need to be addressed that this is why we want them to sign up on the link and schedule a time with the IR team. Like Neil's asking, can I invest through my trust? And so I know everyone's going to have personal, where they're going to pull the money from, how they're going to get access to it. And so I think that's why we've been putting up this link here throughout the webinar, making sure that you have a chance to go on there so you can schedule a time with one of our IR team so that they can help answer your personal questions like that of where that money's going to come by or how you pull it out.
Awesome. I just saw someone said the link's not working. I know that Rosie's getting on that right now. So someone asked, about a 1031 exchange. Here's the thing. We're doing cost segregation, bonus depreciation. Someone did ask that if we're gonna do one. Yes, this property will get depreciation. It's 80%. I think it's right around 4.5 million on it. That should tell you the math. If the equity is 10.3 million, it should be right around 4.5 million, something like that. That will be, depending on what your ownership is, that's what you would get. So we already have an investor in at 4.5 million, right? So once again, we're raising another couple million is all. I think there's only 2 million or so left on this deal. So once again, at 16%, where you saw the numbers of what we have to sell the property at to get the 16%, this is actually going to fill up very, very fast. So Monica, you said you're accredited. That's awesome. So if you get in before the 15th, this is actually going to fill up very, very fast. A lot of people have actually asked for opportunities with us. We don't have a lot of non-accredited. This is actually opening up to non-accredited. I know that Eric has $2 million that is interested in investing. That's where it only leaves us with 2 million left, right? Only leaves us 2 million left. So you'll want to make sure that you jump in pretty quick. I know someone asked a question, can I invest with my trust? I think you just addressed that, Eric.
Yeah, there's just been a couple like that, right? The trust and the 1031. And that's why I say the importance of setting up individual so our team can go over with them individually what their situation is and how to get involved.
Awesome. So I know they'll continue to put in the link there. Tony, you can click right above there. I think they just posted the link again. But so let's go into the $100,000 investment to see what it looks like. If you're doing 50, right, you can do the math. Obviously, I'm putting 300,000 my own money into this deal. Why? I'm just going to work for us, right? I mean, we want our money to work for us. That's the amazing thing is we put our money right alongside you guys as well, right? I think that's important that operators do that. I just think it is. Why not? If you believe in the project enough, right? On the original investment, we have close to $1 million. On this one, we're putting even more money into it as well. We want our money to work, and we believe in this project. So on a $100,000 investment in year one, so you can see 6,000 all the way across the board. That gives you $30,000 in cash flow in the 5 year. If we were to hold it for 5 years, okay, the equity would be $80,000. So that's a return of $110,000 plus your initial investment is $210,000 investment, or you look at a 2.1 equity multiplier. So I always hate that one, Eric, because when people say equity multiplier of 2.1, right, it's just your initial capital that you get back, right? Which is a great thing. I guess in Forbes magazine asked one of the top concerns that people actually get their money back. But so 2.1 equity multiplier there. If you invest 100 grand. Now someone asked, hey, can I invest as much as I want? Schedule some time, with the investor relations team, and they can go over that as well. Oh, sorry, guys. Hang on. Let's see here. Someone said I got to share a link again.
Oh, that link there.
Oh, can you do that, Eric?
Yeah, I'm going to try and share it then too, because I'm not sure why Rocio's isn't going through. Let me see what I can do on it here.
Awesome. Let me get this here really quick. Okay, good deal. Let me share again. All right, so that's a $100,000 investment. Okay, we told you this in the DFW area. We told you how it cash flow. We told you about the value add opportunities. We have 74 units that still need to be fixed up, right? 74 units. Now, remember I talked about organic growth. Anytime that you can force appreciation, right, it's going to make those numbers go up as well, okay? So All we have to do is have organic growth to hit the numbers we're at. Now we can force the appreciation. That's the value add opportunity. Okay. That's about $150 under market on those 74 units that we have, which is amazing. Okay. Went over the cash on cash return. You saw that this average is 8.7%, which means what? Preferred returns are at 6%. Does that mean that this property should have the ability to pay you preferred returns? Yes or no? If it averages 8.7% cash on cash, right? Should this property allow you to pay your preferred return? Yeah, absolutely.
I'll answer that too, Ryan. Someone just said they're getting cut off because of the storm. Their internet's crashing. Wanted to know if this call would be recorded.
Yeah.
So they can go back and listen to it. So just want to address that too.
Yeah, it should be recorded. I'm hoping. Yeah. So here's the thing, guys. Here's the thing is the risk assessment exit strategy. Here's the reality. Real estate is a risk. And we went over that. Okay. Those getting in as a restructure, right? The new debt will be on top. The old debt will be below you. Everything gets done in a waterfall, right? Where the new debt comes in, right? The old debt will get paid out afterwards. So like I said, it's a great opportunity for you and the new debt coming in. The new debt will be the ones that participate in the depreciation. Someone said that. Will the old investors get the depreciation? No, they've already received depreciation. They will not get depreciation again. The other thing is this. We had other partners on the deal. They will not be on this deal. MF Capital Partners and Caleb and Nate are actually partnering up. We'll be on the GP team. Nate and Caleb have a construction background, right? Which is amazing. Those 74 units, right? Being able to fix those up and be able to maximize the returns on those will be an awesome opportunity. Okay. So part of what we do in any project, right? We assess the property, we analyze it, we do due diligence, we acquire it. There's phases in properties. One is typically we're going to stabilize the property. Even though this is our existing, we always want to stabilize it. We're actually bringing in a new management company, AMC. AMC is amazing. Their portfolio, right? What they do on their projections is 2.6% higher in their pro forma than 2.6% higher than what pro forma is. I want you to think about that. As a management company, they manage over 127,000 units. So in their portfolio, being able to do that is an amazing thing, right? It's an amazing thing that they do that. Okay. Typically after you stabilize, you have a value add period. Okay. We're going to rehab those 74 units. We're going to fix those up. We're actually putting washers and dryers in where we'll charge $40 a unit. Huge value add there, right? Huge value add. Like I said, we talk about organic growth. These are some of the things we're going to do to force the appreciation as well. Okay. Obviously, we're going to manage that asset. We're going to manage the heck out of it. And the exit strategy, we're going to look at around the 24-month mark. We're going to see exactly where we're at, where the market is at, have cap rates come back down, and is it a pivot or is it the right time to be able to put it on the market? Now, once again, it's driven off what? NOI, and it's driven off cap rates. Okay. If those align and in the right area, we're going to sell the property. Okay. So once again, we're also going to see, we said 16%. One thing we love to do is we love to under-promise, over-deliver. Okay, always under-promise, over-deliver. So once again, if we look at a 2-year mark and you guys could get 25% return on your money, would you reinvest with us again? Eric, what do you think the answer is going to be to that?
Absolutely, right?
Well, I would hope, right? You know, if we said 16%, they get 25%, the first 2 years, total return would be 50% there. I would hope that they return and invest again. I would hope the hell they would, right? So that's what we do as a company, right? If we tell you 16%, part of our job is to under-promise, over-deliver, right? I'm never going to come to you and tell you 23, 24, 25%. In fact, our investor relations team, I tell, don't ever use 38%. I don't ever want to hear that out of your mouth because our job is to under-promise, over-deliver. If we hit those numbers, great. But in our business plan, as we underwrite it, we're conservative, right? We know what we can do and what the property is actually going to do and what the returns are. But we're never going to tell you, hey, it's 25% because we want to make sure we hit those numbers. Like y'all said, in today's market, 16%, if you could hit that and you know you could hit that, why wouldn't you invest in it? I literally went to Chase the other day, Eric. I was telling Eric about it, just a couple of days ago. I went in the banker I have. He said, Ryan, man, I see what's in your account. I want you to invest with us. And of course, they're we're hitting us up, right? They're hitting me up. Invest. So I asked my wife, I said, listen, should we diversify our money? And so she's like, all right, let's hear him out. So he go and he said, I said, all right, great. I said, what's your returns, right? And he said the 10-year is 10.3%. And I about fell out of my seat. And I told the guy, right? I told him, I said, his name is Rafe. And I said, Rafe, listen, I'm like, we can get over 16% on our deals. We can get over 18% on our deals. Why would I invest 10% into a deal like this? I mean, obviously, you know what I do. You know what I do for a living, what my returns are. I look at that. That's why I say I'm putting 300 grand into this deal alone. So that's awesome. I love it. So let's talk about next steps here. Okay. The next step is this: place your reservation. You've seen some links there. Click on those links. Make sure you hit that. And place your reservation. Like I said, this is going to go fast. There's only about $2 million left on this deal. We want you guys to be, included in it. We want you to invest. It's a phenomenal opportunity in today's market specifically, right? Sign those subscription documents. Okay. Someone asked, Monica, you asked a great question on that. Okay. If you have, if you're accredited and you don't want to go through the pain of having your CPA or get verified, right now is the right time to invest. Plus, you don't want to wait and then have the opportunity to pass you up, right? And then obviously next step, wire funds. So 3 things: place your reservation, sign your subscription documents, wire the money, okay? So we want to close on this deal fast, okay, guys? We want to close on it fast. So here's the thing. In that link, you can get into the portal. You can fill out your investor profile, okay? That tells us a little bit about you, what your investment criteria is, tells you how much you can typically invest. So as we have future opportunities, we can reach out to you as well. So make sure that you fill out that investor profile. The team will get a hold of you. Some of you may just be ready to do it, right? The PPM documents are not uploaded right now. Those should be done in the next 2 days, I'm hoping. As soon as we get those, that's why you're going to click your reservation. It's first come, first serve. Click that reservation. As soon as those documents are in there, they'll be placed into the portal, and you can finish those documents at that time. I know I just got the phone with our SEC attorney, and I know they're just finalizing it up. So Texas take a little bit of time to get entity docs. This new entity will not be called Aspen. It'll actually be called Riverwalk. Riverwalk, right? There's a river in the area close by. Lindsay, our asset manager, came up with it. It's a beautiful name, so it'll be called Riverwalk. We're actually rebranding it. So once those PPM documents are ready for Riverwalk, right, those will be placed in the portal. You'll be able to finish those at this time. That'll be this week. Once those get, I encourage you, right, to move as fast as you can. So awesome. I'm not going to have any Q&A today. But actually, you know what? Let's open it up to a few questions. If there's anyone that has any questions.
Did you see the one up there, Ryan? In your 5-year example, are you paying taxes every year or only after year 5 exit?
No, we pay taxes every year. The beautiful thing too in Texas is, 2 years ago, the taxes went up 40%. They went up crazy, just like insurance went up, quite a bit. And in those taxes, actually, Governor Abbott jumped in and said, guys, this is crazy, right? It's crazy because of what the market was selling those properties in 2019, 2020, 2021, right? And so what happened is the market, because properties were being sold so high, okay, taxes went dramatically up. Governor Abbott stepped in. They've actually done a mock vote to say that the valuation of properties can only go up 5%. Like I said, it went up 40-something%. We actually protested. We protest all of our properties, right? So we can pay the lower taxes on it. Property taxes, if they get carried away, could kill a deal. And my wife, actually, I have to drink a lot of water, Eric. My wife says I talk loud when I jump on webinars. I probably do. They probably hear me down the office.
At least
you probably don't need your speaker on. You can hear me down there, right?
Yeah.
Anyway, so they're capping it out at 5%. So that's gone through a mock vote. Almost every single person voted on it. So that should be implemented hopefully here soon.
And then will you be accepting more than 10.3 of new investor money? Mike was wondering. It seems like it would reduce the debt load, he says. And, could you expand on that thought?
Yeah, no, Mike, we're not going to do any more than that. Because the reality is this, right? It's always a strategic play. I've been asked that before. And the reality is if we're paying 16%, okay, but we only have to pay, the lender 5.8%. It's a matter of being able to pay the debt service. Obviously, the 16% gets paid later on. But in the numbers that we did, that's what we feel comfortable with to be able to get the returns that we're talking about. Sometimes it doesn't pay to pay down the debt piece, right? It's leverage. It's leverage. We want to use the bank's money to be able to make money as well. So there's definitely a fine line there. What's the prep for accredited investors? Right now, we just have, it's a 6%, James, 6% on that one. What's the cost to restructure the debt? That's at 2%. So it's a little over 200,000 is what it's going to cost us to restructure the debt. We're treating it as a new debt piece, James, not a refinance. A refinance, one of the reasons we're treating it as a new debt piece is to avoid some of those refinance costs. So yeah, great question there. Actually, we're redoing the restructuring the debt with the same lender. So that actually avoids some of that restructure cost. So I should have gone into that a little bit more, but that's one of the things we're able to get away from. What risks do you see with this deal? Great question, James. You're just loading those up with great questions. So what are the risks we see with this deal? Here's the reality, man, is interest rates were going up. We had a rate cap on it. Going into a fixed rate is that's what you want in today's market. You want to go into a structured debt piece. And so that structured debt piece is right at like 5.8%. That 5.8%, right, is right where the interest rate's at today. Okay, so this property will actually cash flow better than it has been because we're going into the long-term debt. So that's one of the beautiful things. Plus, obviously, the loan went from 18.6 million down to 10.3, so it actually cash flow a little bit better, which is an amazing thing. One of the risks that you see with it, with the new money, James, there's not a lot of risk to it. For existing investors going into it long-term, we've got to be able to sell the property at least 34 million. So it's our goal to be able to sell it for higher than that. Okay, that would be the only risk to existing investors, or that once it's about investor experience. One of the beautiful things about MF Capital Partners is this: if our investors don't get the returns that they're supposed to get, us as a GP side, right? Us as a general partnership side, we don't take any money, right? We want to make sure that you're getting your returns first. We want a long-term relationship with you guys. So I think that speaks volumes of our deal. I'll tell you, one of our worst deals, James, is a deal that we had in Texas, right? It's another deal that we did at the same time. Actually, we purchased it 3 months before this deal, and COVID related, we actually sold it. And the returns to investors, the projected returns were 18%. We hit 18%. If we would have structured it the way that the private placement or the PPM stated, right, the operating agreement stated, and did the splits that way, investors would have made 13%, and we didn't want that to happen. So we gave up what we would have made to investors to make sure that they hit their 18%. Remember, James, it's not about one deal, right? It's not about one deal. It's about you reinvesting with us. And I think that's for all of you guys, right? It's about you continuing investing with us. If we have to take the hit on one deal ourselves, then we may take the hit. We want to make sure that you're getting your returns that we're projecting to you.
Hey, Ryan, I know we're going to be wrapping it up soon, but I like this question here. She just so we make sure everyone understands. It says you mentioned 16% and 6%. What's the difference?
Yeah, 6%. That teaser. I would say it's that teaser money, right? Every investor wants to get a little bit of money on their investment. They don't want to wait till the very end, right? Like an equity play. You want some cash flow up front, and then some equity, on the back end. Sometimes, we have investors say, it's an equity play for me, so they don't necessarily care about that cash flow as you go along. So what I mean by that, I think it's Romania, is hopefully I said that right, and if I didn't, I apologize. But is some investor, if they put 100 grand in, they want to be able to get some cash flow, right? So 6% would be $6,000 that you would get a year on that $100,000 investment, and then the rest of your money would come as we sell the property in the form of equity, right? That equity growth. So hopefully that explains that question. Like I said, hey, we're going to wrap up. Like Eric said, first of all, I just want to appreciate your guys' time and say thank you for joining us and entrusting in us the opportunity to invest. As you saw, we have a pretty good track record. We've done 28 deals. We've gone full cycle on 13 deals. And you can see in those deals what our returns are, right? It's an amazing thing, right? Our returns are phenomenal. There's a reason our returns are phenomenal is we're always solution-based, right? We're always looking ahead. We're forecasting out of what needs to happen, right? More importantly, we put the investor, the investor experience first. For us, it's a long-term play. I look old as hell. I'm actually young. I'm 45, right? Someone said I look 50, but listen, I'm 45, man. I want to be in this business a long time. A lot of you, my goals are the same as your goals. I want generational wealth. I want my kids to be able to see this. I want to leave something for my kids later on. I had a grandfather, man. He invested in multifamily. And I'll tell you this, when he passed away, he put money into a trust fund that lasted 28 years. All right. Lasted 28 years when my family was able to go do stuff. In fact, I've known Eric for quite some time. When we were younger, 21, 22, he was able to participate at a place called Lake Powell that my grandfather's money, his trust, left to get a houseboat to where all my dad's family is able to get together every single year. Eric actually came to one of our family reunions we had there. And that's what my grandfather left us, right? And family was important to him, keeping that together and making sure we are able to enjoy just a family experience. So I have the same goals, right? And our goals are the same as yours, right? We want to make sure you guys fulfill those goals. You create generational wealth and you're letting your money work for you, right? So once again, listen, there's some links that they posted in there. Click on that link. Like I said, we've got about 2 million to fill this. We know it's going to go fast. If you have any questions, click on that link. Hopefully I'm one that gets to call you as well. But thank you so much for joining today. Once again, that recording will be sent to you as well. But you guys have a great day. Thanks so much.
Brian, thank you. Great job, Brian.